Dr. Akin, and I am your accounting tutor to help you thrive in your financial and managerial accounting courses. As always, these are how-to videos, and so the goal of these videos really is to teach you exactly how to do it. I trust that you're using these videos in conjunction with your lectures that you're getting from your amazing professors. This is just a resource where you can go and study and get additional practice or clarifying concepts. And so please make sure you like, comment, and share. Share this with other accounting students you may know because this information hopefully will be helpful. All right. So as I do with all my videos, I have to kind of do a mini lecture or do mini talking in order to set a foundation for how to do what we're going to do, which today we're going to be looking at the bank reconciliation. So if you already know this information, you can just kind of speed this. You can skip past this to get to when we actually are going over the problem together. But for some that may want to get more information around the concept, I'm just going to go ahead and kind of lecture for a little bit so you get it. So we are looking at bank reconciliations. A bank reconciliation is essentially taking your books or the general ledger and the bank statement and trying to marry them and make them one. Okay, so it's a report or a tool to help track cash. That's all it's really doing in layman's term. It's a tool that we use to help track cash and to make sure that we're on top of our cash. As you know, cash transactions are a lot. You can look at your bank account and see how many times you've used cash throughout the entire month. How much more a business, right? And so there is a necessity for us to track our cash. So we use a tool called a bank reconciliation to do that. So a little bit about a bank reconciliation that you need to know is that a bank reconciliation indeed is a report. It is an accounting report. It's not a financial statement report, but it is a report. And with all reports in accounting, it requires a three-level header. So when we say three-level header, we're talking about the business name, the report name, and the date of report. So in this case, the business is going to be Dr. Akin. Bank reconciliation is going to be the report name. And we're going to look at this for the month of December. Okay, so we're going to look at transactions for the whole month of December. So first thing you need to know, it is a report that requires a three-level header. Next thing you need to know, number two, which I alluded to earlier, bank reconciliation is taking two balances and making them one. So taking two balances and making them one. So the real question is then, what are those two balances? Well, the first balance is called book balance. Now, a book balance is our balance. It's what we can control. It's the books that we can control. So examples that you may see or iterations of this term book balance, it shows up in different ways depending on the publisher or depending on the professor. Professor may say book balance, some may say journal ledgers, others may say accounting records or our books. Hey, if you see any of these, they're all saying book balance. All right, they're all saying the same exact thing. So you have balance number one, which is book balance. That's what we can control. And then balance number two is going to be the bank statement balance. That's who we're banking with. PNC, Wells Fargo, Navy Federal, Bank of America, Chase, all of these things. So we have book and we have bank, and we're trying to put them together and make them one. All right, that's all we're doing. So I want to talk about, I'm going to go through these examples here. I'm going to go through these examples, and so I can show you how to fill them out. What I did was this example, I'm going to give you the answer. I'm going to work out these problems over here. So this is specific to these problems. However, what I try to do is I try to put some transactions inside of the sections so you can at least have some type of template or frame of reference that if you remember these and the sections that they're associated with, no matter where you or no matter what exam you're taking, no matter what professor, this will always be true. Okay, this will always be true. All right, but this is subject to change depending on the actual transactions that occur. Okay, so before we get into the transactions, I want to talk about a little bit more about the format of the bank reconciliation. We talked about the three-level header. We talked about the book. So there's going to be a section called book balance, and then there's going to be a section called bank balance or bank statement balance, right? Or in fact, let's just call it bank balance. So it's just clean and easier. All right, so you're gonna have two sections, book and bank, right? Remember, the goal is to make two of these which they will never equal. So you wanna put that up front. The book will never equal the bank. It just won't happen. The book will never equal the bank. All right, so the goal is that you're going to think, we're going to take some numbers, two different numbers, and we're trying to make them one. Now, I want you to think about, how do we do that? How do we take two numbers and make them one? Well, we're going to have to add some things, which is the plus section. We're going to have to subtract some things. Quite simple. So there's going to be a plus and a less section for each section. So for the book balance, it's going to be plus and less. For the bank, it's going to be plus and less, okay? And then after plus and less, obviously, you're going to have your adjusted book balance. So this is the balance after you do all of your adjustments. Now, as you see here, color-coded, this balance should, this book balance, adjusted book balance, should match the adjusted bank balance in the end, all right? So let's look at some examples, and we're going to be done. So this is really not that difficult of a process. So the first, it says the following information, is available to reconcile Dr. Atkins' book balance of cash with his bank statement cash balance as of December 31st. On December 31st, cash balance according to what? So you want to highlight that. According to what? The cash balance according to the accounting records, right? What do we say? Accounting records falls under bank or book. What is right there? It falls under book. So we can come here and put already 32,878.30, right? We can put that in there because we know that this is the balance. Without touching anything, without doing anything, the book balance is 32,878.30. So one thing I failed to mention is that with this reconciliation, there's going to be a final number column and a math column. Final number column is what the name suggests, it's the final number. The math column is when you have multiple transactions under one subsection. So because there's going to be multiple transactions under one subsection, there's going to be some things, and you'll see in a second. But because we know that the 32,878.30, that is going to be the final number for the book, we just go ahead and put it in the final number column. All right, more to the point, it says, and the what? Bank statement cash balance, so we want to highlight, that is 46,822,400. So let's go ahead and put that under bank. We're going to put 46,822,40, right? So now you see, right now they don't agree. So we have to add some things, subtract some things to make sure that this equals this, right? And we have to do the same here. So how do we do that? Let's go to the first one. It says check number 1242 for 410.40, check number 1273 for 4,589.30, check number 1282 for 400 are, you want to highlight this, outstanding checks as of December 31st. Now, outstanding checks, these are checks that we have cut, but the bank is unaware of. Okay, so checks that we have cut that the bank is unaware of. I want you to think about that, for example. Checks that we have cut that the bank is unaware of. Well, if we knew we cut the checks, you would think that it's already included in our records, right? So this balance is already going to include the fact that these checks, that we cut these checks. But what may not be included, it may not be included in the bank statement balance, though. It may not be included in the bank statement balance. So what we need to do is we need to include all of these checks in the bank statement balance. But here's the thing. I want you to pay careful attention. Now that we know that it's coming out of the bank, the real question is, are we increasing this amount or are we decreasing? Well, they're checks. What are checks meant to do? They're meant to decrease. So we're going to come here and put all of the checks in there to decrease. So all you simply do is put check number 1242, and you want to put the amount 410.40. Then you have check number 1273, and you want to put the amount, which is 4,589.30. And then we have one more, check number 1282 for $400, right? So we have that. Okay, let's move on. Then it says with B, so we done that. Check number 1267 had been correctly drawn. That's an important word, so I'm gonna highlight that. For 3,456 to pay off office supplies, but was erroneously, that's another important word, enter into the what? Accounting records. Okay, so there it is. So what's happening here? It says that there was a check that was correctly drawn. That word correctly drawn simply means, I'm going to put it here off to the side, cleared by the bank. Okay, so in other words, the bank took $3,456 from our account. And it says that they correctly did that. They were supposed to do that. However, we recorded it in our records as 3,465. So we made the mistake. Erroneously, a lot of students kind of trip up off of this word. Erroneously just means mistakenly. All right, so just mistakenly. So in other words, we mistakenly entered into our records 3,465. So with that in mind, do we need to correct the bank or our book? Well, it was correctly drawn from the bank, so we need to our book. So think about what's happening here. So we know that we have to figure out our book. Now the question is, do we increase our book or do we decrease it? Well, what's happening here? It says that this was supposed to come out, but this came out. Okay, so in other words, the difference between the two, which is 3,465 minus 3,465 minus 3,456. So this $9, right? We took out in other words, we took out $9 more than we need to. We took out $9. So from our balance, we took out $9 more than we need to. So that means that this balance is $9 less than what it should be. So how do we make this $9 more than what it should be? Well, we're just going to put it in the plus section. So I'm going to come here and put, I'm just going to put check error 1267, right? And I'm going to just put the $9 in there. And then I move on, right? I move on from there. I'm going to, all right, cool. Let me just move on. So, all right, it says the bank statement, so we're good. The bank statement shows a $762.50 NSF check received from a customer, NBA Industries, in payment of its account. Okay, so that's one. Then the statement also shows a $99 bank fee in miscellaneous expenses for check printing. All right, so what's happening here? So there's two things. Number one, it looks like we were given an NSF check. Now, NSF check, you want to write this down or just keep it in your notes, is called a bad check. Now, I know that I'm talking to not millennials, I'm talking to Gen Zs, right? Gen Zs and maybe even some alphas, right? So I know y'all may not know what a check is. But back in my day, we used to have a check. And what happens is that if you sign a check, it takes a while for it to come out of your account. So if you sign a check, and let's say it takes 30 days for it to come out of your account, if you don't have that money in your account, that check is going to bounce, right? Check is going to bounce. Okay? And bounce just means it's not going to clear. Right? And what we call a bounce check, we call it a bad check. A bad check is also known as an NSF check. So what happens is when you have an NSF check, which is a bad check, you have to, the bank is going to charge you, right? The bank is going to charge you. But look at what happened here. Someone owed us $762.50. They wrote us a check. We thought the check was good, right? So we thought the check was good. So obviously, if we thought the check was good, we're going to include it in our book, right? But when we go to the bank says, actually, this is a bad check. The bank says this is a bad check. So what do? We need to decrease what we thought, because we put in there initially that they owed us. We put that they paid us. So we put money coming in, but in reality, they said it's a bad check. So we actually need to reduce it. So we're going to come here and put NSF check. We're going to put the book less, and we're going to put NSF check for $762.50. All right. And then it says, so we did that. Then it says, and again, you can see it here. This is the template, meaning even if you don't do these exact problems, you can always count that these are going to be correct. All right, so you just want to maybe screenshot that or just keep that as your study. It says the statement also shows a $99 bank fee and miscellaneous expenses for check printing. So what happened? Now the bank is charging us money. Now, how do we know that the bank is charging us money? Well, we looked at our bank statement and we see that our balance is a lot less than what it should be. So what do we need to do? We need to go to our book and we need to subtract out the bank fee from our book because the bank already captured in their amount the bank fee that they charged us, that they took out from our account. So we're going to put $99 in bank fees under the less section book. All right. So we keep moving. It says the bank statement shows that the bank collected $18,980 cash on a notes receivable for the company. All right, so what's happening here? The bank collected money without us knowing. Okay, so think about that. The bank collected money without us knowing. Where do you think that would go? The bank has already included the money they collected on our behalf, but we didn't know, so we need to include it in our book. So we're going to put a book, and we're going to put it under plus. So I'm going to come here and put notes receivable, and I'm going to put the 18,980 in there. All right. So please note, even after we did all of that, it still isn't balanced yet. Let's see if there's anything else we need to do. Oh, there is. Dr. Atkins, December 31st, daily receipts, okay, of $9,583.10 were placed in the bank's depository on the date but did not clear or did not appear in the bank statement. So what happened here? When we say daily cash receipts, we're referring to deposits in transit. So deposit in transit is like, think about your mobile deposit. I know I'm talking to, again, Gen Zs and Alpha. Y'all don't know what a check is, but you definitely know what a mobile deposit is, right? If you receive a check, you take a picture of it on your phone, and what's going to happen? They say, thank you. Give it 3-4 days for the check to be approved and posted, right? Give it 3-4 days for the check to be approved and posted. That's all that's happening here. We deposited $9,583.10, but the bank says, hey, give us 2 to 3 days for it to post. So what do we need to adjust? Do we need to adjust our side or the bank side? Well, it's going to be the bank side because we already know we deposited the money. The bank is yet to post it on our account. So we're going to come here and put deposits in transit. Okay, and we're going to put the amount. So we're going to put the amount, which is 9,583.10. Now, here's the good thing. The good thing is because there's no other transaction, we don't need to put anything in a plus section. All right. So therefore, we can just carry it over to the final column. So all we need to do is just add this number to the final column here, the sum of these two. And guess what? Look. The numbers equal, right? So that's it, guys. That's how you do a bank reconciliation. But here's the thing, though. We're actually not done yet. We're not done yet. There's one more thing about bank reconciliations that we need to do, and that is corresponding journal entries. Now, the bank reconciliation requires that you do journal entries. Why? Because if we're making an adjustment to our book, we need to record the adjusting journal entries, right? So with that in mind, let's go ahead and do our adjusting journal entries, right? Let's go ahead and do our adjusting journal entries. So if you remember, if you don't know how to do journal entry, I encourage you to go check out my previous videos entitled Journal Entries Made Easy. So that way you know how to do it. But I'm just going to kind of speed through these because this is solely about journal entries. Okay, this is solely about journal entries. Okay, so let's get started, or solely about bank reconciliation. So again, like I said, you want to remember, we are only recording journal entries for the adjustments. We're only recording journal entries for the adjustments in the book balance. We're only recording journal entries for the adjustment in the book balance. Why are we not recording adjusting journal entries for the bank? Because we can't control the bank. We can only control our books. So therefore, we're going to do our journal entries. Now, because these are adjusting journal entries, the date is all going to be the same. It's going to be December 31st, right? Because all of this is happening at the end of the month. So the first journal entry we want to do is this check error for $12.67 for $9. So if we go back to the problem, it says that right here, it says we were essentially trying to pay for office supplies, right? That's what we were trying to do. We were trying to pay for office supplies. So what do you think we're going to debit here? Oh, here's a good thing. Let me just stop to say this. When it comes to doing journal entries, here is the good news, guys. Already half of the journal entry is solved for you because all of these, any adjustments here are going to be to cash, and it tells us the direction is either we're going increasing cash here or decreasing. So here's the good news. You already did half of the journal entry on this reconciliation. So here's the example. If we have in the plus section check error for $9, what are we saying? That we're going to debit cash. We already know that we're going to debit cash for $9. You see? This is very, very simple, right? It's already structured for us to win because it's in the plus. In the cash section, we're going to do a debit to cash for $9. Now, the credit is going to be found in the problem. Well, the credit is going to be office supplies because that's what we were paying for. So we're going to credit office supplies for $9. And guess what? We're done. We're done. All right, so we did that one. All right, next, we're going to keep the same exact dates because remember, this is all happening at the end of the month. Notes receivable. What are we going to already do? We're going to debit cash already because it's in the plus section of book. So we're going to debit cash for $18,980. See how we didn't even need to think about it? And we're going to credit what the problem says, which is notes receivable, right? So we come here, credit notes receivable for the same amount. And look, you see how quick that is? It's not that I'm moving fast. It's just simply just not that difficult, right? Then we're going to move to the next one, right? So look at what's happening now. There's a shift. We're in the less section of cash. So how do we reduce cash? We credit. So we already know that the second half of the journal entry is going to be a credit, okay? And if we're looking at NSF check specifically, the NSF check is going to be for $762.50. So we know, again, that we're going to credit cash for $762.50. Now, what would the debit be? Well, if we go to the NSF check, it said it was for a customer, MBA Industries. So if it's for a customer that we thought owed us, what account does that deal with? Accounts receivable. Okay? And remember, accounts receivable, accounts receivable is money they owe us. And also to the point is, listen, we thought they were going to pay us. They paid us, so we reduced our accounts receivable, and now we found out we have a bad check, so we need to put it back on our books that they owe us money, right? And let's do the last but not least one. So the date is going to stay the same. It says bank fees, again, $99. So we already know automatically that our credit is going to be for $99, right? Our credit is going to be $99. That's what we know, okay? What we also know is that the debit is going to be what it is, miscellaneous fees, right? That's what it says in the problem off to the left. Miscellaneous expenses, rather, or miscellaneous fees, same thing. And boom, we're done. See that? We're done. All right, you all. If you have any questions, feel free to email me. My email is in the description. If you want access to this, email me. We'll give it to you. You all have a good rest of your day. I hope you crush it on your exam. Boom.